Okay, I've given it about the 5 minutes. This is being recorded, so I might just kick it off so we can ensure that we can complete and finish on time. So thank you everyone for joining us today. My name is Jacqueline Hannon from Hannon's 360, Director of Hannon's 360 for those who don't know me. We're very fortunate to be joined by both David and Jeremy from BetaShares. And David will be presenting today. He's one of BetaShares Economists. He's been with the team since mid-2014, has had an extensive background, so he doesn't mind me saying, and obviously looking at the markets and whatever else. And we're very fortunate to be able to have David and Jeremy here today. And they're going to talk a bit about the volatility in the market, what's been happening. We're seeing interest rates on the rise, we're seeing inflation going up. We've seen in the US market, there's obviously been a significant downturn for anyone who's watching the markets. So we're very fortunate that they're going to be able to give us a bit of an insight, long-term outlook on what's been happening, and hopefully allay some of the fears that some of us might have. So with that brief introduction, I'll hand over to both David and Jeremy. Just a bit of housekeeping before I do, just letting everyone know that I do have everyone muted at the moment. There is an opportunity for you to put any questions that you may have in the chat box. And certainly towards the end of the presentation or potentially throughout, you'll get an opportunity to ask some of those questions as well. So if you'd like to just put your questions in the chat box, we'll be monitoring those and you'll have an opportunity to potentially query some of those things as well. So I will kindly hand over to yourselves, gentlemen, and when you're ready, I think you've got the ability to share that as well.
No worries. Thank you for having us here this afternoon, Jackie, and it's a pleasure to be able to speak to some of your clients this afternoon. Welcome, everyone. My name is Jeremy Benson. I'm one of the Queensland Advisor Services, part of the Queensland Advisor Services team here at BetaShares. One of many of us that work at the company. I think we're now over 100 in staff, which makes us, I think, the largest ETF provider, certainly by staff numbers in Australia. Look, I think as Jackie just mentioned, we're happy to, or David's happy to take questions along the way. We're always keen for these sessions to be interactive. We will be saving time at the end today for a question and answer session, but by all means, feel free to put questions in the chat box along the way. And we'll do our best to answer those at the appropriate times. As Jackie mentioned, maybe just a little bit more background on David. He is our Chief Economist here at BetaShares, where he's responsible for developing economic insights and portfolio construction strategies for our advisor clients and their clients. But David has worked here at BetaShares for getting close to 10 years now, I think. So well and truly been established here for some time. Prior to that, Dave actually started his career working for the Commonwealth Treasury of Australia. So I think the department where a lot of the big economic decisions and insights are created and made. So Dave comes from a very strong background in this space. Prior to BetaShares, actually, he did write as the economic columnist at the Australian Financial Review, the AFR magazine, a newspaper that a lot of you might be familiar with. So some of you might have read David's stuff in the past. For those that haven't, you're about to get a nice taste of his knowledge and views on the markets and how everything operates. All right, I will share our presentation here. Just before we go on, I might just start with the disclaimer that anything here that I guess we provide is just general advice in nature. It's not to be taken as personal advice. That's why you have a financial advisor to help you with these sorts of decisions. The other common disclaimer that past performance is not indicative of future performance also holds. Just a quick overview for BetaShares for those that are maybe not too familiar with us. So we are an Australian fund manager that was founded almost 15 years ago in 2009. We have the widest range of exchange-traded funds in the market, or ETFs for short. We currently have 74 ETFs. of which a handful of those are in the model portfolios that I believe some of you guys are invested in via your advisor, Jackie. We're managing almost 25 billion of funds under management at the moment, which again makes us one of the largest fund managers in Australia. We were given some figures just last week, actually, that we have close to 750,000 Australian investors across the country using at least one BetaShares product in their portfolio. So we're well and truly loved by Aussie investors. That you can see through, obviously, our funds under management, the number of products we have, the amount of offices we have. We have now over 100 staff across the country and New Zealand. So yeah, look, that's a little bit of a background. I think that's probably enough speaking from me. I'll let David get into his presentation for this afternoon, which, as Jackie mentioned, we'll be covering a bit of an economic update, what's been happening in interest rates and fixed income markets, what's been happening in the share market, and a bit of a look at our model portfolios, for which David is the Chief Investment Officer of and makes sort of all the major decisions there. All right, David.
Nice. Thank you. Hi, everybody. Great to be with you today. And just going to see if I can open this up. Is that allowing me to see? Yeah. Well, actually, what I want to do is do the view. So similar. How do we do the view?
Yeah, sorry, we'll just
view.
Sorry, we're just trying to set this up in a more convenient presentation.
If you click those slides.
There we go.
Sorry.
I got it.
Oh, if you got it. Yep.
Just wanted to make sure I follow my narrative correctly. Great to be with you all. So I'm going to give you an update on the state of play in terms of the economy at the moment, what the financial markets are looking like at the moment, and how that's been reflected in the model portfolios that we run. And as Jeremy mentioned, look, I'm the Chief Economist here. I'm chair of the BetaShares Investment Committee that meets quarterly to review the models, but we do have a number of other staff on that committee, including our Chief Investment Officer, some of our portfolio managers as well. So we definitely meet regularly and talk about the state of play in the economy and the markets. So here's the first chart, the Australian unemployment rate and inflation. And really, as you can see, this is the COVID effect. So COVID came along, we had to shut down for a number of months. The unemployment rate got up to something like 7.5%. The effective unemployment rate got a lot higher, something like 15%, if you were to count people who weren't actually working but were, I guess, getting JobKeeper payments and still being attached to their employer but not actually working. But with the recovery, with the reopening, the rollout of the vaccines, the fact that we've basically been able to reopen the economy. We've had a very strong rebound in the economy. The unemployment rate today has dropped all the way to 3.5%. 3.5%. Now, that is a level of unemployment we haven't seen since at least the early 1970s. So it's really quite an exceptional period that we're going through in the economy with very good employment gains. Partly because the other aspect of this is that we have closed the immigration, international immigration, skilled migration hasn't quite come back to where it was prior to COVID. And so in a way, when we have strong demand and we tap, we in the past, we've usually tapped like skilled migrants, which has helped to fill some of the skills gaps and the labour gaps. But the absence of that has helped this unemployment rate really come in. Now, that's the good news. The bad news is that inflation has broken up and it's higher than we've been accustomed to of late. So if you've got the headline measure pushing up to 6, in fact, we get a CPI, an updated CPI for the June quarter tomorrow that's likely to show consumer price inflation over the past year up over 6%. The trim mean is a more of an underlying inflation measure, which strips out the direct influence of very volatile items like petrol prices, for example. But even on that basis, inflation has picked up. And now, we're not alone in that. So if you can see on the next slide, inflation's picked up in most countries around the world over the past year. And in essence, what we've seen is we've had a strong rebound in global growth as we've got out of lockdown and got back to shopping and wanting to travel, and the supply has taken a while to catch up, and so we've got a demand, essentially an imbalance between demand and supply over the short run. Now, partly also because fiscal and government spending to support the economy during COVID in many countries was very strong. Central banks, including our own, cut interest rates to very low levels, and so that really fueled a strong rebound in demand. And at the same time, we did have some, and basically the supply chains, like production coming out of factories around the world, particularly in Asia, freight, tankers that export freight around the world, these sort of big cargo ships, they're not equipped to deal with that big, strong rebound in demand. And so that's why when you hear talk of supply bottlenecks, and yes, there are supply bottlenecks, but in large part it's because demand around the world has just been so strong. Now, one of the reasons we've seen central banks respond to that by raising, basically central banks are responding to that pickup in inflation and the fall in unemployment by raising interest rates. And rightly or wrongly, I'm just going to share with you what central banks are thinking about the world at the moment and why they're doing what they're doing. And it's really to not repeat the mistakes of the 1970s. This is a chart of the US unemployment rate at the top. The grey areas are the periods where the central bank in the US was raising interest rates. So from the trough to the peak of the official interest rates in the US. Now, you can see inflation in the early 70s on the back of, in particular, two oil price shocks when the OPEC group was formed and the many Middle Eastern countries that had large control over oil supply, restricted supply and jacked up prices. It was a major, supply shock, but it did feed through to a sustained pickup in inflation because we really never allowed inflation to drop back down. Basically, that got embedded into inflation expectations, and we got an increase in wage and price setting behaviour that basically embedded that initial inflation shock that got embedded into the system. So if you look at it here, inflation rose through this period, and central banks basically stopped raising interest rates as soon as the unemployment rate, I'm talking about the US here in particular, as soon as the unemployment rate started to go up. So they stopped raising interest rates when unemployment started to rise, even though inflation and over that period was still rising. Now, and so as a result, the economists look back on that period and say they never really tackled inflation. They kind of flinched, and we allowed it to get embedded into the system. So central banks today are facing a very strong lift in inflation, very tight labour market, as I pointed out. So the US unemployment rate, like us, is down around about 3.5%. And so the central bank is raising interest rates today to slow demand, to reduce inflation, and in particular prevent what inflation expectations picking up. If workers have got strong bargaining power and they think inflation is running at 5%, they're more likely to demand a wage rise of close to 5%. Now, if the economy is strong and businesses feel that they can pass on that wage increase, then they may accept that wage increase and then pass that on into price increases of say 5%. And then workers are going to respond to that and say, oh, I've got a 5% wage rise, but you know what, now it's been offset by prices going up 5%. I'm going to demand another 5% wage increase next year. And that's how that, what economists call a wage price spiral, due to an increase in inflation expectations, can get embedded into the system. So central banks today are trying to stop that from happening, and doing that by raising rates and telling people, we're going to slow the economy if need be to get inflation back down again. So don't rely on inflation staying as high as it is at the moment. So the US Federal Reserve has been raising interest rates, albeit very low levels. Now, interest rates around the world are still very low, but they are certainly higher than what they were a year ago. So the US Federal Reserve, the America's central bank, has lifted interest rates from basically 0 to almost 2% today. This week, they're going to raise interest rates another 0.75%. And possibly several times thereafter, and get the so-called policy rate in the United States up to around 3% at least over the next few months. Reserve banks also followed suit, I'm sure as you know, have been raising interest rates. Our official cash rate at the moment is about 1.35%. They're likely to raise interest rates 0.5% again next week, taking it to 1.85%. And probably raising rates to at least 2.5% and possibly up to 3% over the next, 3 to 9 months in Australia as well. Now, what we are seeing is that as the US is raising interest rates, the US economy is starting to slow down. Now, there is talk of recession. I mean, there is a risk that the US does have an economic downturn, at least, over a short period, say 6 months to 9 months. And this chart just shows you that, if this is the US unemployment rate in grey, and this is the Australian unemployment rate in orange, these grey periods are periods that are defined as a recession in the US. There's a group in the US that officially judge when recessions begin and end. And really, the point of this chart is to show you that when recessions hit in the US, their unemployment rate tends to go up, as you would expect, but our unemployment rate also tends to go up. So when the US economy slows, our economy does tend to slow somewhat as well, and our unemployment rate goes up. So there is unemployment today is quite low. It's probably too low, to be honest, because there's a lot of worker shortages. And if the US does succumb to a slowdown to get inflation under control, then the risk is that unemployment in Australia will also rise somewhat over the coming year, from about 3.5% at the moment. Now, as I mentioned, just in terms of the interest rate, so that's been the backdrop that the central banks are reacting to a lift in inflation. They don't want to repeat the mistakes of the 70s. There is a risk that the US will slow down as a result, possibly going into a recession, at least over a period of time, and that could hurt our economy to some extent. Now, with that regard to interest rates, this is the current situation where what markets are pricing. So these are market expectations for what the RBA cash rate in orange and the US federal funds rate in grey will do over the coming year. And as you can see, markets are already pricing in further interest rate increases, going up to around about 3.5%. But then if you notice, the markets then think that at least the Federal Reserve will be cutting interest rates in the second half of next year. Basically, they raise rates, they slow the economy, they get inflation under control, and thereafter they can then backtrack a little bit and cut rates. That's what the markets are expecting at the moment. In terms of Australia, we're not really pricing in a lot of rate cuts at the moment, and really this still remains the focus of market attention at the moment, is the prospect of further rate rises to contain inflation, and the debate being, how far will rates need to go, what impact that will have on the economy. And just to summarise, basically it all comes down to how quickly inflation globally will fall. If it falls quickly over the next few months, as growth slows, central banks can then quickly stop raising rates and may be more inclined to cut interest rates. So it really does depend on how quickly inflation falls, is going to determine the economic outlook for the next little while. Now, my base case is that at the moment, I think it's not going to be easy for inflation to fall either in Australia or the United States quickly, because demand currently is still quite strong. There are some shortages still, and really to get inflation down, you need to slow the economy. So you can't have one without the other, essentially, is my judgment at the moment. So that means that, they will look to raise rates, and there is a risk of a downturn in the US economy as a result. But from the bond market point of view, so just to point out, financial markets are forward-looking. There are people in terms of what a lot of things that we talk about are often already priced into financial markets. As I said, so the bond markets, the fixed income markets are already penciling in increases in interest rates, such that if you look at long-term bond yields in Australia, this is in orange here is 10-year bond yields, and bond yields in the United States here as well in orange. And this black line is what the market expects the cash rate to do over the following 12 months at any given point in time. And as you can see, we've gone from a period of middle of last year, so I've lost the dates on this chart, but the same dates are here. But the middle of last year, the markets were expecting no increase in the RBA cash rate over the following 12 months. 10-year bond yields are at 1.5%. And then we've gone from expecting no move to them raising rates to at least 3.5%. And that's why bond yields have gone up. And that's why we've had returns. Again, if you look at model portfolios that have fixed income bonds in them, as our portfolios do, the returns on bonds have been negative over this period because rising interest rate, rising bond yields hurts the value of fixed rate bonds because basically a bond offers you a fixed set of interest payments going forward over time. And as the interest rate available generally in the economy goes up, the future value of those income payments is reduced in present value terms. And so that's why you get the value of bonds going down when interest rates generally tend to go up and vice versa. So that's why you've had negative returns in bond markets over the past 6 months because of this major repricing of interest rate expectations. That's the bad news for bonds. The good news is that I think most of basically the markets have already priced in what's likely to happen in terms of interest rates. So again, unless you think the markets and the central banks will raise rates by more than what is currently expected, i.e. around about 3 to 3.5%, then bond yields shouldn't need to go up a lot more than where they are. In fact, they're actually easing off a little bit from where they peaked back in June last year. And so that means the negative returns on bonds that we've endured over the past 6 months should ease, and in fact we'll start to get positive returns from the interest income that we're getting. And in fact, going forward, the yield returns on bonds will be higher because the level of interest rates on those bonds is now higher. So that's the bond market. Let me get this moving the right way. So just in terms of, and that was that's a comparison of Australia versus the US, in that markets are expecting us to raise interest rates basically by the same degree as the United States. Now, I actually think that's probably too pessimistic. One of the reasons being, if you look at the unemployment in Australia is similar to the US. They're both around 3.5%. But wages growth in Australia, at least as officially measured at the moment, is quite a bit lower than what we're seeing in the US. It's actually still running at only 2.5%. Has picked up from the COVID lows, but nonetheless still pretty low. Whereas in the US, it's running at 4.5%, 5%. So there's a stronger case, and inflation overall is running at a higher pace in the US. So there's a stronger case for the US to raise interest rates, but less of a compelling case for us to raise rates as far as the US. So there's even more likely, good value in the bond market here in Australia. The other positive on bonds, at least in the US, and why I don't think you'll get a lot more tightening than what's already expected, is that the aggressive moves by the Federal Reserve in the US have already started to dampen inflation expectations. So this chart is a chart of what the bond market expects inflation to be in 5 years' time, basically. What it expects over a 5-year period in 5 years' time. Again, they can work that out from looking at the yields available on various long-term bonds as they're priced in the markets, and you can sort of back out what the implied inflation expectation would be. And as you can see, a few months ago, it was looking as if inflation expectations were getting out of hand, rising in a significant way. But with the RBA, the Fed raising rates, inflation expectations have since come back. They're still a little bit elevated from where we've been, just prior to COVID, but From a longer run point of view, they are sort of back to the, their normal range, which is certainly reassuring. And similarly on the household front, inflation expectations were rising, and there was a risk that they were starting to get out of hand as well, or again, a term that central bankers use and economists is unanchored expectations, where we want them to stay around 2 to 2.5%. They keep pushing up to 3, 3.5, 4, 5. That's when, we say expectations are becoming unanchored. We want to re-anchor them, peg them back to the long run desired level of about 2 to 2.5%. So you can see household inflation expectations have also come back somewhat in the US. And this is based on a survey of consumers. I mean, there's a group that goes out and they survey a bunch of households every month, and they ask them, what do you expect inflation to be over the next 5 years? And this is their average result, in case you're asking. The other element is that the US economy is already starting to slow. So this is a weekly jobless claim. So it's the number of people that are turning up at state unemployment offices in the United States, and it's the states that handle the sort of unemployment benefits in the United States. But it gives us a very timely read on the strength of the labour market. And we're starting to see a softening in that more and more people are still very, very low by long-run historic standards. I mean, this level here, just over 150,000 weekly jobless claims, is like the lowest since the early 1970s. If I did a long-run chart of this, you'd see how low it is. But nonetheless, it has started to lift, and that's an early telltale sign that conditions are starting to soften. Which adds to the case of the Fed. Yes, they'll raise rates, but may not need to do a lot more than what's already priced into the market. So just in terms of bonds, I mean, again, some of these ETFs are in our model portfolios. OZBD is now in our model portfolios, which is an Australian bond fund that includes both government and corporate bonds, and that's offering you a yield now with roll, like a prospective 1-year income return, assuming no change in interest rates, of just under 5%. Given that back up in yields. So that's a lot more attractive than it was even a couple of years ago. A year or so ago, that would have been, 1.5%. We also have some floating rate exposures. So these are bonds that are not sensitive to the level of bond yields, but you can see there about 3% return on our floating rate bonds, as they're called. That's included in our models. A couple of other income exposures that we have. These aren't in our model portfolios, but they're definitely available as an ETF. They are bank hybrids and a broader range of hybrids. And again, they are floating rates, so they're not as sensitive to what happens with bond yields. They are sensitive to what happens in the economy because there's a credit element to them. If credit spreads widen, if the yield on government, if the risk premium on corporate bonds goes up, then their effective yield can go up as well, which hurts their returns. But at the moment, they're also offering fairly attractive yields, again, of just under 5%. Aussie dollar, what does all this mean for the Aussie dollar? Aussie dollar, as you can see, over the course of the past year, was in this pretty narrow range between 70–75% over much of 2021. It's more recently broken down below 70 cents. It's around about 68–69 cents at the moment. And principally because the US dollar, this is the US dollar index. So this is the value of the US dollar against most currency, an average against all the currencies of major currencies of the world. And the US dollar has been strong over this period, again, because the Federal Reserve has been raising interest rates. The US economy has been strong. Investing in the US market, particularly the bonds and cash, has become more attractive vis-a-vis other markets. And so that's caused a nice strength in the US dollar, which in turn tends to weaken the Aussie dollar. The other thing happening is iron ore prices have weakened. And going forward, I think the Aussie dollar is going to remain under pressure probably for the next 3 to 6 months or so, as we go through a bit of a slowdown in the US economy, as commodity prices continue to soften. So it wouldn't surprise me if the Aussie actually drops lower, maybe to 62, 63 cents over the next 3 to 6 months. Moving along, just want a share market update. Now, the share market, I'm sure as you know, has had a bit of a setback in recent months. Our share market's been doing better than the global markets, particularly the first part of this year, and that was because initially when interest rates globally were going up, they were hurting the so-called growth parts of the market. Companies with not a lot of current earnings, but a lot of strong earnings potential. They were trading at high valuations. Many of these are technology type companies. Many of them are in the US market and not that many in the Australian market. So the weakness of the so-called technology growth companies particularly hurt global markets, but didn't hurt our market as much because we don't have that many of those companies in our share market as a share of the share market. The other thing that helped our economy, market, was that the resources side of the economy was still going strong. When Russia invaded Ukraine, it jacked up energy prices, jacked up gas prices, oil prices, food prices, and indirectly boosted a lot of the commodity prices that we benefit from. And that helped support the resources sector of our market. But again, with the global slowing, we are now starting to catch up a little bit to that slowdown. And this chart just shows you that, look, the US market is, I think, still vulnerable to a bit more weakness over the next few months, because the grey line is the price to earnings ratio of the market. It's the price of, so-called PE ratio. It's prices relative to the level of earnings of companies on the share market. And at the moment, it's come down. The PE, the ratio was at 20 times earnings late last year, so very high from a long run perspective. It's since come back down to 16, but it has got lower when the US has had a growth slowdown or a recession. So I just think this may well drop a bit lower over the next few months. And the other thing that may happen is earnings growth. This orange line is annual growth in corporate earnings in the US. At the moment, it's plus 10, so 10% growth over the same level of a year ago. In a US downturn, it can weaken to be minus 10, minus 20%. So that's the risk also over the next few months. So now, having said that, there are upside, and in fact, you can see it from this slide. Well, actually, I'll just focus on that slide. It's probably just as easy. Now, it's not all doom and gloom. I mean, as I said, the backdrop here is we've had a strong economy, inflation's picked up, central banks need to raise rates to help bring down inflation, and most importantly, to keep inflation expectations in check so that we don't generate a wage price spiral while we're waiting for inflation to come down. As I said, if inflation comes down quickly, the Fed will stop raising rates, and equity markets may already be near a bottom. The other thing that may happen is that the equity market, as we saw during COVID, the US may go through a downturn, but the equity market says, that's fine, but we don't think it's going to last very long. We don't think it's going to be that deep, and it's probably going to help bring down inflation, allow the Fed to eventually cut interest rates. So if the equity market may well hold up, so the prices hold up relative to earnings. So that's another scenario to be a watch for. But importantly, I think a key takeaway here is that the inflation that we've got at the moment, one way or the other, is going to come down. If it takes a slowdown in the US to do it, so be it. If it comes down of its own accord, great. But one way or the other, inflation, and including in Australia, is going to come down, which is going to keep a lid on interest rates, and it's going to support growth going forward, because there's no real trade-off. If you tolerate inflation at 5 to 6%, it eventually hurts the economy because interest rates go up. So you really have to tackle inflation. You can't. There's no trade-off. Let's not avoid a slowdown and accept higher inflation. In the long run, that doesn't work. So, as I said, there's a light at the end of the tunnel here. Central banks have learned the lessons of the 1970s, going back to what I was saying earlier, and are going to try to make sure inflation does come down. Just on that, I mean, look, this is a chart of the declines in equity prices vis-a-vis their peak levels. So it's like a drawdown. So you can see there's the 20% line. So when the US market has dropped by 20%, we say we've entered into a bear market. So the US market has had a few bear market periods. There was the GFC. There was the the tech bubble back in 99, 2000. There was the GFC, the market dropped quite a bit. COVID, you had a drop as well. It's pretty sticky. Can't move this that well, but basically, when the US has a downturn in the equity market, our market tends to follow to some degree. So if the US market is going to experience some weakness over the next few months, it's likely our market will experience some weakness as well. There's a saying in the markets, when the US sneezes, we catch cold, and I think it still remains the case. Some good news, though, as I said, that some of the high growth. This is a chart of growth. These are companies trading on a high valuation in orange versus companies trading on a lower valuation in the dark, the black line here. So this is for the US market. So you can split the US market into companies trading on high valuations, and they're typically called growth stocks, and those trading on lower valuations, and they're typically technology type companies, and those trading on lower valuations, and they're typically things like energy companies and financial companies, banks. And for a while, in that period of low interest rates, growth companies got very expensive vis-a-vis the rest of the market. As I said, the first leg of the downturn in equity markets since late last year has been these growth companies being hit the hardest. And so their valuations have come back down to a more reasonable level. So again, a bit like bond yields, they're probably near a peak. The period of underperformance, at least in terms of these growth parts of the market, has probably passed. Now, if the overall equity market declines a bit more, they will decline, but they probably won't decline by a lot more than what the overall market is doing. Just another chart of that. This is the NASDAQ 100. Again, we have an ETF that tracks the NASDAQ in the US.
Something that Jackie's been using for some of her clients, I believe. So
yeah, and so the NASDAQ includes a lot of the, many companies that many you would be familiar with, the big tech companies like Google, Amazon, Facebook, Netflix, and that was and this is back in the tech bubble, back in 99, 2000. Companies in the NASDAQ were trading at a very high P of 80 times earnings. Now, just up until late last year, it was starting to get a little bit pricey, not as bad as it was back in the tech bubble, but just above its long run average of about 30. It's now come back down to a reasonable valuation, back to around about 20 times earnings. So again, the valuation premium, if you like, has sort of come back to a more normal level. Some other things to be aware of that are doing well is the FTSE RAFI Australia 200 index. What on earth is that? That is a broad Australian equity ETF that we maintain, and you can see over time it's tended to outperform the Australian 200 index. Without going into a lot of detail, basically this is and again, I bring this up because it's one of the exposures we have in our model portfolios. So we have two exposures for Australian equities. One is a very low cost ETF, only 7 basis points, that tracks the market weighted by the market capitalisation of companies. It's sort of very similar to the ASX 200, not exactly, but very similar. And this other one basically weights companies by long-run financial metrics like book value, earnings, like a 5-year moving average of these underlying financial metrics. And the beauty of doing it that way is that you avoid increasing weight to companies when they get too overpriced. Again, the thing with a market capitalisation index, if a company goes up in price in a major way, its share of the market on a market cap basis goes up. And so the market cap index implicitly or basically de facto increases its weight to that company. Whereas a fundamentally weighted ETF like the FTSE RAFI index, where we base it on long-run earnings, long-run dividends, book value, it won't increase its weight it'll actually avoid increasing the weight to those companies. And similarly, companies that drop a lot in value, if they haven't dropped a lot in terms of fundamental value, this index won't cut its weight to it. And the beauty is often you'll find companies, going too high in one direction, going too low in the other direction. And so by not chasing that performance and not adjusting your weights, this fund over time, this index over time tends to beat the Australian, the market cap index. So that's, you wanted to say something?
Yeah, I might just add, you know, just also looking at this chart being a long-term chart, we can see here the power of long-term investing. So I think, as some of you might know and have seen, you know, the share market's had a very tough start to the year. So has the bond market. I think this is the worst bond market we've seen in history in Australia. So it has been a tough year for investors since probably about Christmas last year. And you can see on this chart, I think the performance of both the ASX 200 and this RAFI Australia 200 just in the last couple of months has really, you know, has started to drop. But if you were a long-term investor, you can see here that your returns would have been very, very strong over time. Oh, sorry. So if you just scroll down. Once we just pull that chart back up. So yeah, look, while there might be some short-term pain happening, I think with everyone's portfolio, certainly my own portfolio is hurting at the moment. I think this chart probably just reinforces the benefits of being a long-term investor. Had you invested $100, actually, if you just go back there for me, Dave. Sorry, our mouse is doing something a little bit funny. Oh, sorry, Dave. Do you want to just there we go. Oh, here we go. I can use this. Had you invested 30 years ago, your money would be worth more than 20 times your initial starting value about 30 years later. So if you work out those as an annual gain, it's a very, very strong return. So I think that's just an important message, that markets don't go up in a straight line. There's a lot of volatility, as we're aware, and we're going through one of those volatile patches right now. But as you can see, markets in the long term do go up as companies grow to become stronger and stronger. I'll pass it back to Dave.
Yeah. So, you know, again, the other way to think about the equity markets is the price of admission. You know, volatility. You get a higher long-run return for equities, but you do have to, you know, endure, you know, bouts of volatility, and market rewards you for being able to, you know, endure that volatility. Now, quality, another one that we've included in our models at the moment also, and it's a core holding, is quality. So these are companies, what are quality companies? Companies that typically have above average return on equity without too much debt. And if a company has a good return on equity, it generally means it's generating, you know, good earnings and should have good earnings growth over time. And companies that have good earnings growth over time usually have good share price performance over time. So, you know, one sort of follows the other. It's a typical kind of screen that Warren Buffett would look at, for example. He looks at a bunch of other things ultimately, and he goes to talk to individual companies. But the first thing he would look at when he looks at the company is return on equity. So the orange line there is our global quality ETF, or the index that ETF tracks, vis-a-vis the world index. And you can see over time, a bit like you know, the RAFI fund that I mentioned before, does tend to generate an outperformance when you do, you know, give a higher weight to companies with strong return on equity. Now that's had a bit of a pullback along with global markets more recently. In fact, you know, it's actually fallen a little bit. And one of the what's quality at the moment does tend to have a bit of a technology growth. When you screen for companies with above average return on equity, given that the very successful performance of the US tech companies in recent years, they tend to figure amongst that. And because of the sell-off in growth and technology in the past 6 months, quality's had a bit of a sell-off as well. But from a long-run perspective, as I think growth over value, quality over the broader market will continue to outperform. Just to conclude quickly on the model portfolios. Look, it's been a challenging period for the models. For not only any model that obviously has equities and bonds in it. Doesn't matter which has had a challenging period. So you've had like just in the June quarter just passed, and look, I guess focused on the last 6 months. we've had some declines in the bond market. Don't know what's going on there.
Sorry, guys. Maybe do you want to just?
I won't touch it.
Yeah.
Okay. So you can just focus on the last 6 months. You know, really since the start of the year, with the aggressive interest rate increases, bond returns across a number of bond funds have gone down, and equities, particularly global equities, over that period have had declines. So that's why, you know, when you look at the models, you've you know, not just our own, but any diversified portfolio would have had a bit of a setback over the past 6 months or so. How we've positioned the models at the moment, though, is we are a little bit underweight equities, again, on the view that we may get a bit more weakness in the equity market over the next few months. And that has been put into cash. Within bonds, we're overweight Australian bonds. So again, I think the RBA is not going to raise rates as aggressively as the markets think, given the still relatively benign pace of wages. Also, the sensitivity of the economy to interest rates. We think the economy will prove to be quite sensitive to interest rates, and hence the RBA won't need to raise rates all that much. So we're really just being a little bit defensive at the moment, and then we'll see how that plays out. But you know, hopefully, as things play out and we get on top of inflation, we'll look to go back to a more neutral position and maybe even go underweight equities and enjoy some of the ride as we go overweight equities and enjoy some of the ride into the next, you know, the bull phase of the market. That's just a summary of our strategies at the moment. I won't read that in detail, but you know, within the key theme there is to being a little bit underweight due to the aggressive rate rises we're seeing in the United States at the moment. Overweight Australian bonds versus global bonds, but pretty much a neutral exposure elsewhere at the moment. And, you know, not trying to take a view on Australian versus global equities at the moment, because when equities are under pressure, you know, it's not really the time to sort of choose which one's going to do better than the other. It's really just choosing how defensive you want to be. But going out the other way, we'll see if it's a commodity boom coming out the other side. I don't think it will be. You'd want to be overweight Australian equities. If it's a return to growth and a technology boom of the sort we enjoyed prior to COVID, as the models were back then, we might then go back overweight global equities. So we'll just see how things play out. But that would be my inclination. You know, when we do go overweight, possibly we'll be going back to a more overweight global equity position. That's it for now. Obviously, just emphasise what Jeremy said earlier. This is just general economic information, and you know, obviously seek professional advice. So you're in very capable hands there in terms of seeking professional advice. So I think I'll leave it there, and time for questions. Happy to take some.
Thank you so much, David. That was very insightful. We've actually got a bit of a team chat, and we've sort of just been commenting on how wonderfully you present, and really just break down all that jargon and help to clarify things for us. So thank you very much for that. So I think I had some key take-homes that I've just jotted down here. So not all doom and gloom was probably one of the key ones that I wanted to hold on to, because I think with the significant interest rate increases and seeing it bump up so quickly, instantly, that fear for anybody who lived through the interest rates that, you know, climbed up nearly 19%, if not hit the 19%, there's that fear that it's just going to keep going. So, so just sort of re-summarising that, so we're feeling comfortable that the significant increase in the interest rates is really just to hit the inflation on the head, and really to avoid these ongoing challenges. And we're seeing that flatten off in next year. Is that correct?
Yeah, look, I just because central banks are raising rates aggressively now doesn't necessarily mean that the end point for interest rates is going to be a lot higher than, you know, what you think. They're actually, you know, they're getting back. Interest rates are still below normal. They're still like below average, and they're sort of getting back toward normal, maybe a little bit above normal. But the difference is that rather than doing it slowly, they're doing it very quickly, and that's because they're worried about inflation expectations. So it's really the speed of the move rather than the outright move that is, you know, jarring at the moment. But I think you'll find, you know, they'll get to where they need to be, but that endpoint won't be certainly nowhere near what we've seen in history, and it'll still be pretty low from a long run perspective.
Well, the Reserve Bank of Australia, Jackie, regards the neutral or the normal interest rate in the market of 2.5%, right, David?
Yeah.
So I think the market's forecasting at the moment that interest rates will go up to around 3.5%, so a bit more than neutral, just to slow things down. As David pointed out in a chart earlier, the market was forecasting interest rates of 4.5%. Next year. Only last month in June was the market forecasting that, but because interest rates are now starting to go up quickly, you are starting to see signs that the economy is slowing down. So the market has revised their expectations lower. They're now not expecting 4.5% next year. They're now expecting 3.5%, and they might not even get to 3.5%. But yeah, certainly the times back in the day of 18 or 19%, I think the economy's changed a lot since then. Everyone's mortgages are a lot bigger than what they were, and given that mortgages are probably one of the biggest parts of where our income goes to, we're very sensitive to changes in interest rates. So I think that's certainly a big factor for why interest rates don't need to go back to the levels that they have been decades ago.
Yeah, that's certainly very reassuring. I think one of the comments, again, in the team chat that we talked about is, for some of those, particularly with the market changing in the property market and those prices going up, and now all of a sudden money being quite cheap in the last few years, that people have gone and mortgaged themselves to the hilt. Has there been any commentary around what that looks like, and fears and concerns around people now in a position over the next 12 months potentially not being able to pay those mortgages and now having to sell? Are they concerned about that, or are they feeling that the market should be comfortable enough to weather the storm?
Look, the RBA's looked carefully at the incidence of what impact rising rates will have on household balance sheets. They've looked carefully at where the debt is, who owns the debt, the distribution of fixed versus variable rate loans, how many people took out fixed rate loans back in the COVID days. Now, a couple of key conclusions from this. From a macroeconomic point of view, firstly, from a financial stability point of view, i.e., will what happens to rates cause any significant risk to banks? Like, will there be major debt defaults, bad loans on the banking balance sheets, dare I say, sort of a GFC type event that we saw in Australia, in the US, in Australia. And many global investors have often worried about Australian banks and their exposure to the housing market. Now, in the main, the RBA's conclusion is there's very low risk of a major, implosion in terms of debt and insolvency. Most of the debt held by households is held by high-income households, people that are able to service that debt. So that's a very important point when you consider the overall macro financial market implication. Now, if you look at the distribution of, who owns. Now, the other thing is, like, 2/3 of households don't have a mortgage. They're either renting or they own their house outright. So of those with a mortgage, we're talking about 1/3. So it's still, it's still 30%, but 2/3 won't have a mortgage. Now, and of that, many are ahead on their repayments. So of the 1/3 that have a mortgage, roughly say 1/3 again will face significant increases in repayments. So there will be some pain for some households that have mortgaged themselves up to their necks, as some want to do. But they, to some extent, if they got a loan, again, let's remember, in theory, hopefully in practice, when people that get loans need to be able to satisfy the so-called buffer requirement. They need to be able to, their income needs to be able to, they need to be able to demonstrate that they can pay off the mortgage even if interest rates went up, say 200 basis points, even 300 basis points. That's a sort of called buffer rule. So assuming they met that requirement, then even those that face a significant increase in repayments should be able to meet it without having to, default on their loans, which in turn would cause, more house price weakness. So there's various, grounds for, comfort when you go through the details of it. Now, there will be some households, again, what you've got to do when you think about these things is distinguish between, when you ask about something that's happening, from a macroeconomic point of view, you're going to say, well, what percent of people are going to be affected, and will that affect the overall economy? No doubt there will be pain for some people, but not enough to cause broader macro pain. So one area of pain will be those that took out a fixed rate mortgage during COVID, like sub 2%. They're facing either a significant increase in their repayment ratio because they'll be put onto a variable rate, or if they want to refix, they'll have to fix now at a higher rate. So undoubted will be some discomfort for some households, but the percent of households affected is still considered small enough not to have a major macroeconomic impact. So it's really that's the broad conclusion one would conclude out of that. House prices, having said all that, I mean, house prices in Australia are still likely that they are falling at the moment. Now, are they going to fall, 50%? No. Are they going to fall 10%? Quite possibly. So nationally, somewhere between 10 to 15% would be my expectation of the decline in house prices nationally. In Sydney, could be a bit more than that. And it comes down to mortgage affordability. As interest rates go up, the average household can't afford to pay more for a house when they go to the auction or whatever. So it tends to put downward pressure on price property to sort of re-equilibrate the market, and vice versa. When the RBA cuts rates, house prices go up, and vice versa. So house prices nationally went up something like 25% since COVID, when they slashed rates to zero. So now that they're bringing rates up again, house prices are going to come back down again. So it's the part of the cycle. It's just the way housing market works these days. So I think people, I don't know, be comfortable with it, but it's the reality of the situation.
Wonderful insights there. We assist our clients with home loans, so I can certainly speak to and comment on the buffer that is allowed for. And certainly the talk about town at the moment is that it's comfortable, but certainly beyond that 2% increase, it starts to look uncomfortable. If you don't mind, I just have a couple more questions. Firstly, probably more a comment than anything. I just really appreciate you detailing more information with regards to the RAFI. And I think the other one's called the
quality.
My notes here, the ISA, the quality. I think it's just really nice to see that diversification and seeing something beyond your standard index, like your NASDAQ or your 200 ASX, and to see that there's other ways where an ETF can actually select investments where it's looking at other measures, I guess, and other fundamentals. So I think it's, and those ones are, and you guys will include within your portfolios where you see that the investors will benefit. You'll then substitute some of those stocks investments within those portfolios. Is that correct?
Yeah, I mean, they are sort of like core long-term holdings. So we don't sort of, so we like RAFI, we like the quality index because over time they've just demonstrated some outperformance. So it's just a sort of better way of indexing effectively. Another term for it is smart beta. So we do blend that into the models. And so we think, over time it's going to give you a bit more of a return, kicker compared to just being in a sort of plain vanilla market tracking index.
Yes, and I think those graphs are already indicating the advantage of going beyond the vanilla. So, and then the other thing that I just wanted to, and the last question that I wanted to ask, and is around the labour shortage or the unemployment rate. Now, we work with a lot of small businesses, and we're seeing this pressure of not being able to employ people. We're seeing pressure of having to increase wage rates to obtain and attract team members, new team members. So is there talk around what that looks like? Are we seeing relief on that? Are we seeing that wage prices are going to increase? Like, what does that look like? You talked about the international migration and skills coming over from international and how we've been limited because of COVID. Are we seeing relief from that, or?
Look, I think we will see relief. We haven't seen it yet. I mean, the borders are opening, but we haven't had an influx yet of more immigration, and even the other the foreign student intake as well, which has been useful because many of those students work part-time in the hospitality sector, for example. So the lack of that has contributed to shortages, and hence, wage, as I said, official wage measures at the moment are very benign. So there's been no evidence of wage acceleration, at least in the official stats. Now that might be lags, so maybe over the next couple of quarters, we may see some pickup. In fact, I would expect to see some pickup in those official wage measures. But just as they start to pick up, we're going to see, a slowing in the economy, maybe the unemployment rate starting to ease back up again, and immigration come back again. So I think in the short run, wages the officially measured wages may pick up, but I don't think it's going to be a sort of sustained, increase that we need to be, worried about. And recall, only I think 6 months ago, only 6 months ago, the RBA was hoping for a wage increase because it thought wages were too low. It wants ideally national wages on average across the economy should be around about 3.5%, because that's allowing for productivity growth. I mean, cost savings by businesses over time. It means that it's consistent with inflation staying at around the RBA target of 2.5. So the ideal level of wages growth is 3.5. At the moment, we're still at only 2.5. So it can go up a bit more without it sort of threatening inflation. What we wouldn't want to see is to go up to 6, 7, or anything above 3.5 in a major way. But even if it did in the short run, as I'm saying, even if it did in the short run, I think the slowing economy, the reopening of international immigration would quickly temper that eventually. That's the sort of state of play at the moment.
Thank you so much, David and Jeremy, for your wonderful insights. This is certainly something that we advise on, and I've learned a lot from today, so no doubt everybody else is in the same boat. Again, appreciate the way that you can really disseminate that down so it's, plain and easy to understand, and I really appreciate the exposure to understanding some of the other investments that you have there as well. So thank you very much, guys. I might close it off at that. I really appreciate your time, and hopefully we'll get the unique opportunity to steal a bit of your time in the future. It's been very valuable. Thank you.
Okay, we're always happy to, and thanks for having us, Jackie. It's been a pleasure.